You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome, and you are listening to and watching the Financial Survival Network. I'm Kerry Lutz. Today is April 8th, 2021. Well, there's good debt, there's bad debt. You probably, hopefully know the difference between the two. The person you're about to hear from, well, he definitely does. I'd like to know, what you're doing about your debt, since obviously you're not traveling, you're not doing as many frivolous things, at least I know I'm not, as I was just a year ago. So you should have some money in the bank, and hopefully you've been paying down your debt. Well, let me know about that. Email me at kl@kerrylutz.com. Well, right now we've got Daniel Goodman with us. Daniel, you are a professional day trader, and you're giving out investment and financial advice more in the educational realm. We are thrilled to have you on. So tell us right now, what is the difference, in your opinion, between good debt and bad debt?
Thank you very much. Well, right off the bat, good debt is going to be things like mortgages, no interest payment type setup, and investments that give you, for like a business, for example, maybe you take a loan from a bank to start a business. So things like that. So something that provides, so if you buy a home and you obviously don't have enough money to pay for it in cash, you're going to be in debt. You're going to put down, the minimum usually is about 20%, and you're going to have a 80% debt per se. Now, naturally, this is going to be, hopefully you get it. And, these days, in the last 3 years, you can get anywhere from 2.5% all the way up to, 5%, depending on your credit score. That's good debt. Having a mortgage is good debt. So I hear a lot of people talking about, oh my God, I'm stressed. I have my mortgage and this and that. I have lots of debt. Well, if you can pay your mortgage, no problem. That's a good thing naturally. So your debt, your home is going to appreciate over time. I mean, it just will. The real estate is it's going to have its peaks and valleys. And if you're lucky enough to buy in Southern California, you're going to have mostly peaks. And that's going to appreciate. So in a sense, that debt that you have is going to diminish on its own. So that is investment with a nice return, and you're paying low interest rate. But it's also the main reason your primary residence, for example, is considered good debt is that's giving you shelter. That's your home. This is something you need. It's a must. Another way to simplify it could be that good debt is buying something that you need, as opposed to racking up bad debt, which would be maxing out your credit cards on items that you don't need.
All right. One of the things you mentioned is 0% financing. I don't need a brand new 85-inch flat screen TV, but Best Buy is saying, Kerry, you can have one and you don't have to pay any interest. But look, like Daniel, it's a consumer item. The second I take it home, the most I could sell that thing for, if I had to sell it liquidated for cash tomorrow, I'd be lucky to get $500 for a used flat screen. I mean, used flat screens are worthless. So is that good debt? Because I went and let's say the 85-inch flat screen is $2,000, but I'm not going to pay any interest for 2 years. Is that really, does that really make any sense?
Well, then you got to find the line between, do you need it? Do you want it? And naturally, if you do want it, can you afford it? If you want to talk about, it's easy to talk about TV, 85-inch TV that you don't need. You probably have a perfect good 60-inch that you bought 4 or 5 years ago, but you want to keep up with the coolest technology with TVs and have the 4Q, QLED, whatever have you. So yeah, can you afford it? that's really what it comes down to as well, too. Everyone is allowed to have fun and spend their money. However, and it's funny you mentioned Best Buy. I love Best Buy. I've had a Best Buy account for years. I spend a lot of money on Best Buy. And they have amazing no interest deals. And, look, if you're buying a new oven range, I just got 2 new washer and dryers because the ones I had weren't working very well anymore. They were old. Is that a need? Yeah, that's a need. So, if it might be tough, even if it's tight and you're paying monthly for that washer and dryer, don't be so hard on yourself. If you're like, I'm in debt, if you're making the monthly payments, and by the way, 2 years, 3 years, they offer them for 5 years, depending on the dollar amount. You need that. You need a washer and dryer.
You do. But if your washer and dryer that you got or your flat screen is just old and you want the latest one, look, I like to spend money and have fun just as much as the next person. But there is a point at which you really should, especially after the family's left the home, where you're in you go through cycles in life. All right. You're a kid, your parents are providing presumably for all your needs. Then you go to college, you graduate, and you're on your own, and then it's up to you, but you don't have a family yet. So hopefully you're saving some money there if you're in a position to. But then, you get the family. The question is, I could buy a house and my credit is good. I got an 800 credit score plus FICO score, and I can afford to buy the $500,000 house, the $300,000 house, or the $1 million house. Now, all of them are going to provide shelter to me, adequate shelter. They're all in the same area. Mm-hmm. But doesn't it make more sense to buy the $300,000 one, as long as we can all fit in there, have our space, than to buy the $1 million one just because I want to go splurge and have a great place?
Well, once again, that's where you come back to, can you afford it? I mean, that's just what it comes down to. Can you afford it? What do you want? I mean, are we looking at, depends. I mean, what can you afford to get? And that's really what comes down to. If you can't afford the $1 million home, but you say, you know what, I'm just going to go for it. I'm pretty sure I'm going to get a promotion in my job. I think I'm going to be okay. I got the money now. Is that smart? No, that's not smart. If it's just yourself, don't get a home, get a condo, right? If you have 4 kids, you need a 6-bedroom home. Are you going to buy it in Beverly Hills? You're going to buy it in the San Fernando Valley. I mean, I'm speaking, from in Southern California, but what can you afford? Naturally you can say you can buy, if you can afford an area that's going to appreciate more and be a more stable investment, great. If you can't afford it, don't do it. If you can't afford it, that, ladies and gentlemen, is bad debt. That's bad debt. Now that's bad. Now you can't afford it, and you might lose it. You might have to sell it, so that's not good. That would be considered bad debt. You got to make sure you can afford these things.
But maybe there's really good debt, and then there's debt that's okay debt, right? Maybe you don't really need that $1 million house, even though you can afford it, because you got to make the decision of, would I rather save the several $1,000s a month in added interest payments and taxes and everything else I'm going to make on the $1 million house, take the $300,000 house? I guess the question is here, Daniel, isn't it better to live beneath your means and save the money than it is to live at or above your means and not save the money?
Absolutely. Right. Remember, in this $1 million home that you just bought, once you crunch your numbers, if you have no money left over after you've paid all your bills and you have nothing to save for a rainy day or retirement or whatever, then no, that is not the house to buy. That's correct. So that, like I said, that's not considered affordable. Because if you have a bad year in your business or whatever you do for a living, you get laid off and you have no savings, you're in trouble. You're going to be selling your home. So no, that's not, it's got to be affordable. So yes, remember, good debt can turn into bad debt if you can't afford it. But really, bad debt is going to be considered racking up credit cards. That's really bad debt. Because why? Because it's 25% interest rates. So when it comes down to figuring out good debt and bad debt, you have to have your wants and your needs, and you have to be very disciplined about it. That's for sure. So you can't just do it. Yeah.
If I look back at his definition of good debt versus bad debt, he says that good debt is using debt to purchase an asset that will actually provide cash flow, and bad debt is like financing that flat screen from Best Buy or other stuff that's only going to cost you money. Even a house he considers bad debt in some respects because, there's no income associated with it, and a home is really a consumer item under his definition. So tell me where you disagree with that.
Well, I guess the flat screen analogy, we can go back and say you just moved into an apartment. There's no washer and dryer. You need a washer and dryer. So then if you buy a washer and dryer, okay, that's not bad debt. You need to wash your clothes. Unless you want to use it in your shower or your bathtub. Fine, go ahead. No, yes, you can. I do. So I disagree with anything else that buying, besides a cash flow investment is bad debt. Everything else besides it is bad debt. No, I disagree with that. I do agree with that of course, good debt is something that's going to bring you cash flow. But buying a home, being it's your primary residence or being it's an investment property, I have both. I have investment properties that bring cash flow, that pay for it and profit. And then I also live in a home that I own too, that I pay a mortgage. And all of those properties are going up in value. Naturally, I'm not making money on my home that I live in, but that's good debt. It's gone up since I bought it. I'm in bigger equity since I bought it. I don't see how that can be bad debt ever. I mean, so no, I don't agree with all of it. And like I said, yes, if we're talking flat screens, if we're talking the coolest technology, you got to have the latest iPhone, because you just want to. No, that can turn into bad debt real fast. Absolutely. I guess I can back up and say, listen, if you're going to go into debt because you have to buy that washer and dryer, do it at a no interest cost.
Right.
Yeah.
Otherwise,
Right.
If you got your choice between paying cash for it or, getting the debt. So if you have a no interest finance deal, because they are always hoping that you're going to run into problems and then you're going to have to pay the interest on it after the period. And then, once you pay the interest after the period, you wind up paying all the interest before you owed the money as well. So here, aren't you better off just paying cash for it?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network. The information you need to thrive now more than ever.
Yes, if you have the cash, you should pay cash for it. On the other hand, something that I've done before and I will keep doing, I remember I spent about $10,000 at Best Buy, and it was a 5-year no interest deal because it was $10,000. I took that $10,000 in cash and I bought Apple stock with it. I already have a portfolio with Apple, but I bought it in a separate account. I made that money with the stock and paid for it over 5 years. So that's something that you can do too. Put your money to work. If you're not going to spend the cash on the $10,000 or whatever, maybe take that and invest it into something else. Now, also, a lot of people talk about credit cards. Credit cards are dangerous. We all know that. People say, oh, I can put it on the credit card. Most Americans are in debt because they racked up the credit card and they don't have to pay for it until 30 days later. And of course, they don't have to pay for it. You rack up $20,000, you're going to get a bill for about $300 a month. Oh, great. I can afford $300 a month. 5 years later, you still have that $20,000 bill. Your balance hasn't dropped at all because you're only paying it. In my opinion, credit cards are good for two things. One, an emergency. We're talking about an emergency, or a true emergency. Something's happened. You got to take a flight. A family member is sick. You got to go across the country, the world. You don't have any money. You put it on your credit card. That's an emergency. That's what they're there for. Great. Things happen. The other way to use a credit card is you buy something and you get your perks for your points on a card. But make sure you have enough cash in your bank account to pay it off before it hits, so you don't have to pay any interest. Those are the two things that credit cards should be used for: emergencies and to build up points. Because if you rack them up, yeah, you're going to be in bad debt. That's right. And if you don't have the money in your account, like you just said, you shouldn't be buying it unless it's an emergency. That's right.
Yeah, and the ease, the ability, to convenience, but I would really call it ease of them getting you into debt and getting you in over your head. It really they've made it too easy for most of you out there, haven't they? Isn't it too easy?
Yeah, they can approve. If you have above a $600 credit score, you can get a credit card. I was surprised earlier on in my life when I was 18 and I got my first credit cards. And I couldn't believe it. I was just getting them left and right. They approve you for whatever. And my credit score wasn't great. I just turned 18. Listen, but keep in mind that I made my mistakes. Right at 18, between 18 and 20, 18 and 21. I racked up debt, was irresponsible, and paid for it. And that's, as my father would say, that's the best way to learn, the hard way. And so,
some would say it's,
and I had to pay for it. It's the only way. My credit score was a 500 at one point, maybe even lower. I think it was like a 520, and I couldn't get approved for anything. And then I finally got a $150 credit card and built it back up. And now my credit score is constantly between 775 to 800, and sometimes more than 800. Yeah. Built it up. That's right. So,
hey,
be careful.
Hey, for a 520 credit score, if you have a social security number, you get 520 right there. It's like going into the SATs. If you sign your name and fill out your address properly, you've got a 500.
Right away.
That's really bad. But hey, I've had more debt at some times in my life than in others. Right now, I happen to be debt free, other than a home I'll be purchasing. And, it's a good feeling to not owe anybody anything. There's nothing wrong with that. And with rates so low, you have to go and find opportunities. Let me just pass along a little anecdote to you that I encountered recently. There's all these companies in the U.S. advertising business funding. They will get you funding. And somebody who's a regular FSN member, Joe, he sends me one of these offers. Says, these guys are scammers, check them out. So I go over to Lending Tree. I said, I want business credit. And I get bombarded. No sooner do I hit the submit key, my phone's already ringing. It's unbelievable. Lending Tree is a lead generation platform for every type of loan that you could imagine under the sun. And initially I'm thinking, okay, I'm playing along. I'm going to just borrow $50,000, $75,000 and you tell me what the deal is. And they come back with these offers. We're going to take the interest from your account daily. We'll give you a 7-month loan. And I said, okay, what's the interest rate? And they won't tell you. I said, well, what are my total payments? Because they say, oh, the interest rate doesn't matter. It's the cost of funds. Okay, so what's my cost of funds? And they're giving me a 50% interest rate. Now, that's probably not good debt, is it, Daniel?
That would be the worst debt I've ever heard of in my life. That's bad. That's terrible debt.
Loan shark debt.
That's loan shark. Well, that's worse than loan shark debt. Yeah, I'm pretty sure.
Without the baseball bat.
Tony, John Gotti and Tony, he'd be like, whoa, he wish he could get that much money for loaning it out. The late John Gotti. So that's terrible debt. Stay away from those. I'm glad I'm guessing you didn't click yes, you didn't sign.
Oh, obviously. I was there more as an educational thing, and I did a triple Lutz report about this scam because they won't even tell you the interest rate. They'll give you a payment schedule, but the schedule's got weird dates. It's really hard to figure it out. And then finally, you just figure out your total payments. But when it's less than a year and you're making the payments weekly or daily, it's really impossible to figure out what that thing is, other than the fact that at the end, you paid them 50% more than you borrowed. And it could be in less than a year. I'd just say, like, so it got to the point where, like, they'd call me and they're constantly calling and sending emails. They probably looked at my FICO score, said, oh, we got a live one here. This guy is great. And finally I said, look, I will not talk to you unless you can guarantee me a rate under 10%. Oh, well, we might be able to do that. Yeah, we have lots of clients, liar. And then I say, and here's the deal. Monthly payments. I'm not making you daily payments. I'm not making you weekly. Oh, well, we can't do that. I said, goodbye. Take me off. I don't want to know you. So there is such a thing as bad debt when it comes at too high a rate. But debt, obviously, if it's an income producing asset and the risks have been accounted for, like real estate, whatever, that could be considered better than just no interest loan from Best Buy to get that latest, greatest flat screen or the latest and greatest side loading washer dryer that you just have to have, right?
You're right. No, right. If you want to rack up all your credit with appliances and things like that, of course. If you don't need them, no, we want to save as much as you possibly can. Yeah, that debt you're talking about, lending tree, that's obscene, terrible debt. And, you know, one thing that is, and by the way, I know a lot of hard money lenders too. I mean, the most I've heard is about 15% on money. And that's high. I mean, I haven't heard them charging more than about 15. Anything more, I can care less. Now, if you buy a home cash or you buy a home and 10 years later, it's been skyrocketing, borrowing from that home or refinancing is to buy. So for example, let's say you have $1 million in equity in your home, okay? And you want to use some of that money. You want to invest it. Refinancing your home, especially if you got your home at years ago at 6% interest or 7-8%, whatever you got it at, and now you can refi it at 4, 3, whatever, depending on your credit score. If you want to take $500,000 out of that $1 million in equity, not only are you refinancing and lowering your interest rate, right? So whatever money that you are now saving, that 4% of interest, what you're supposed to do is take that and put it aside. Don't touch it. So every month, right, naturally, every month that you're supposed to be paying $5,000 in interest, now you're paying $2,500 in interest. Take that $2,500 and put it away. Okay, or maybe not, whatever your mortgage is. And then that $500,000 that you've borrowed off of that $1 million equity, go buy a condo. Go buy a $500,000 condo. Okay, and you don't have any debt on that except your property taxes and your HOA fees, but that's okay. Now the renter that you're going to put in that condo is going to pay for your property taxes and it's going to pay for your HOA fees, and anything left over is that's icing off the cake. That's profit. Now you've had, now you're in $500,000 more in debt, but that's good debt because you just bought a piece of equity with it, a condo, and you don't have any debt on that. Now, of course, you got to make sure that you can afford to pay your mortgage with that $500,000 that you just borrowed. But essentially, you're getting a better interest rate, so that's awesome. And look, this is the way that I built the portfolio. This is the way that a real estate portfolio, this is the way a lot of people do it. And that other property that you just bought, maybe in 5 years from now, goes from $500,000 to $1 million. Take out $500,000 from that now, and then buy another property. But be careful. I mean, now that's, of course, over leveraging. And of course, we're going to talk about lending. I mean, isn't this why we had this financial crisis, 08 to 09? Yeah, everybody just, no doc loans. And I just watched The Big Short. I can watch The Big Short all the time. One of my favorite movies. It's a great movie. Anybody that hasn't seen The Big Short, go get it today and watch. Fabulous movie.
All right. Well, it's one of my favorites. Highly recommended. That, an Inside Job, and there was another one, Margin Call, which was phenomenal.
I just watched it again, Margin Call.
It was an amazing movie. So
I love that movie.
In any event, Daniel, thanks for coming on. Any questions or comments, Daniel, just send me an email to kl@kerrylutz.com. Daniel, if people want to find out more about you, connect with you on the web, how do you do that?
Get me on LinkedIn under Daniel Meyer Goodman. Daniel Meyer Goodman, and get me on LinkedIn, and I'll pop right up, and I'm here to help.
All right. Excellent. Well, we appreciate that. Make sure you sign up for our free newsletter at financialsurvivalnetwork.com. Daniel, it's been a pleasure. Good luck.
Likewise.
Talk to you soon.
Thank you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.